Hey, this is Unbring Capital back with a video update. This video update is going to be about price, but also is going to be an insight into the more quantitative side of how we view Bitcoin. And this is kind of to operate in conjunction with the market maker based strategies that we run, in the sense of how liquidity is run for and the tricks and deceptions that these big players use to con retail liquidity on the opposite side of the market. So this will not really deal with that too much, but it will give another insight into how these operations are run and how you can speculate based on volatility compression, where you are in a cycle, and also when any particular move is likely to occur. So part of the Unbring Capital strategy bank includes a full suite of kind of quantitative methods to analyze the markets, and one of them is this, and it deals with the relative expansion and compression of price, and how, despite price over this 14-year window in the chart from 2009 to the present, it's 2009 is there. I've just taken it out of screen because it's not relevant to the point being made later in the video. But despite the moves being so logarithmic and exponential, you can view price relative to a fixed point in time, and that is what people misuse as a moving average, and they ascribe meaning to the moving average. And when a moving average crosses over another one, that is meant to have some sort of significance, despite the fact that they're both essentially lagging indicators. But they still have a use case, and that is purely in the quantitative analysis of data sets. You have to pick a moving average, or what would be called, if you're not a retail pleb, a mean. So a mean point, and you would compare price relative to that data set at previous points, but also price relative to data sets of different moving average lengths or mean lengths. And what you will see is patterns begin to emerge, especially in wholly manipulated assets like crypto. And this is part of what has influenced me to be able to say that there is no randomness really on a macro level in the crypto markets. Everything is done intentionally, and everything is done with a purpose. And we know that. And I have never really delved into the quantitative side of the methods, but we have shared in countless videos and tweets the methodologies that are used by essentially an algorithm. So it's a human coded algorithm trying to effect a human derived plan. And it is the merging of those two understandings that give a more complete picture to the Bitcoin market. So with that, and all markets, especially the ones that are completely manipulated, but all markets. So the central premise of this point is that whilst we have gone sideways diagonally, and if this was 2021, I'd be screaming distribution, this seems to be no different than any other Bitcoin reaccumulation before a markup to test liquidity. And my entire premise I believe since as early as December 2022, but I would have to fact check myself on that. My entire premise is the market maker will bring price back to places where he was able to previously commit retail liquidity on the wrong side of the market. And by that I mean, that sounds like a big bullshit phrase, like just a meaningless phrase. But what that means is, I'm the market maker, I have price up here. No matter what happens, I can keep the price here. I mark up the price here because what I want to do is I want to trap retail liquidity that thinks price is going to retest the highs. And I can do that over and over again by marking up price. And they will but when price is at that level, then you unleash bids because you can see you unleash offers because you know that this markup would have generated the bid interest. So when I say the market maker will return price back to points where he has previously gotten retail to commit liquidity on the wrong side of the market, what I mean by that is he has fooled retail into buying here. This was a bad time to buy. With the benefit of hindsight, anyone can see that that was a bad time to buy. Unless your time horizon is stupidly long. But I think objectively speaking, as professional traders, that was a bad buy. If you did not exit your position somewhere around here, you're still holding that, you're not a good trader. But he was able to get people to buy there, even though they were dead wrong. So why he brings price back there is he knows that that is a point where he can get people to be wrong again. And why these points are important to see is it's the last point. It's the last time. This was the relative swing, the last point at which he fooled retail money. So the idea of bringing price back there is he can do it again, especially if you have a distribution idea in mind. It might not be exactly at that level, but you can distribute around the level, especially if that's what your plan is. So we see, and we can show, and we will show quantitatively in this video, even though you don't have to, because it's observable time and time again in the markets on all time frames that swing points will be retested for that reason. And we can then quantify this, and I will quantify this on a macro basis using multiple metrics to show where we are relative in time to previous Bitcoin cycles. And I believe the conclusion after this video can be none other than Bitcoin is a wholly manipulated market and has been from the very beginning. And I think that should inform one's understanding when they might romanticize about Bitcoin. And it should inform your understanding about the players in Bitcoin. If I can evidence on a quantitative basis the price action today, which we know is influenced a lot by institutional players, maybe even wholly controlled by institutional players, that's a wholly separate video. If we can show that, but we can also show that the price action has been the same since the early days, then I think any rational thinking person would that would inform how they think about Bitcoin and crypto generally as this libertarian gift from God that no one really questions the true origins of in any meaningful way. It's just who's Satoshi, not like could it have been a government agency or worse, central bank or worse. So let us look at relative compression by looking at this indicator, and none of these are indicators which I will ever share the code of, share publicly, really describe what they do, because I just won't do that. So this tracks relative compression, and the data sets on all these indicators are the same length for the purpose of this video, but the real strategy overlays 4 different lengths of different look back periods for a kind of a short term, medium term, long term, and like super long term view. And it's the relative expansion and compression of the data sets relative to themselves, but also each other that influences a kind of a larger picture. But for this, the short term is enough to demonstrate the point. So we're looking for, this is not a directional indicator. None of these are directional indicators. The concept of a directional indicator is not anything I use in my trading or my idea generation. it's just not something that we do, because price is the same upside down as it is the right way around, and double bottom, essentially the same thing. Stop hunt of the high, stop hunt of the low is how I'm able to call these things. It's not rocket science, it's just pattern recognition. You can teach a dog to probably do it. But anyway, so we're looking at these are not directional indicators, I think was the point I was making there. This all of these show expansion and compression. So when the indicator go up, price is expanding, but it can be in either direction. It can be up or down. But the data set is getting wider because it's accommodating, like this is 10, this is 11K, this is 18K, this is 39K. If you shove all of that into a short-term data set, you are going to widen the spread of the data set. You're going to widen the variance of the data set. Therefore, the standard deviation is going to grow. Therefore, the mean is going to grow. All of these things are interrelated. The mean is the standard deviation is a product of the mean. So, by definition. So when this is going up, means that is expanding. So, but that can happen, as you see here, expansion here, but price is going down. So it just means price is on the move. And when it's going down, likewise, the data set is compressing. And in a trend following system, expansion is trend, compression is sideways action. And we see that quite well demonstrated throughout time. Expansion is trend, compression is sideways, expansion is trend, compression. Look at this. I never talked about this, but this was influenced a lot of the 2022 viewpoint because the data set was compressing. So that was the seed of the idea that, okay, this is not bull continuation like everyone thinks. They're not going to be continuation in a macro. They're not going to be putting in a continuation pattern in a macro compressing data set. And we saw that when price started to expand in a meaningful way again, this was the downtrend beginning. Likewise, compression. It was this. If you go back to June, July 20, if you go back to my video around July 2022, I literally said in that video that I'm seeing the first evidence that the bottom might be in. Now, granted, we did stop hunt the bottom, but I think you will agree that the point I was making there is this general bottoming structure, because it was the going inside the data set and the beginning of the compression of this one. And then we saw again when we had meaningful expansion was when we had this sort of trend beginning. So that is an overview of this. This is essentially a derivation of the same thing. It displays slightly different data in that it's a ratio of this area to price. So whilst there will be overlap, it's not the same thing, and the joint signals are beneficial to kind of view in conjunction with one another. So the point is 13 minutes of an intro to get to the point that we can algorithmically measure the retest of liquidity that I always preach about, and how my opinion, unless I too am a retail pleb, is that this is, despite the sort of little wiki price action, as long as we can hold this mean, this for me is, as history will show, a build up to do exactly what I think is about to happen and what I've thought is being prepared for, i.e. the retest of 50K. That is what is about to happen, and we could be imminently about to experience that markup. So if we kind of visualize this pattern, this kind of compressing data set on the upside of the mean, the volatility compression levels, let me just make a rectangle to kind of show that rough level throughout history, and then also this price ratio level. So if we go back in time, and I've drawn this out for you, kind of the breakdown liquidity, the basing pattern, the volatility compression, and the breakup. If we go back to 2012, but they couldn't possibly have been involved in Bitcoin then? How could the CME have been controlling Bitcoin back then to do this exact same pattern? Can't believe it. So anyway, we see that the volatility compression, same zone. And once the expansion started, price began to trend up. The price ratio in the same zone. But look for the retest, and then obviously the clustering at the mean, the compressing data set. But look at where the violent upward trend retested with a wick through the breakdown liquidity point, the same one. It's almost the same thing. The little story I was describing earlier about committing retail thinking it was going back to the highs, that being the breakdown point. And look at that. Look at this. There's not a coincidence that this volume, I don't have it on this chart, but that's obviously a high volume candle, came in at this level. Wick up through it and down. Similar to what I believe will happen here. Do you see how that is the same as what we were just looking at? Fast forward to the next cycle. There's the same breakdown liquidity point. This was more of a, I guess you could kind of draw it here. This was the breakdown liquidity point into the low. We had the same, we're going to do this one. We had the same levels in the price ratio. Granted, we had this longer volatility compression under the level. But the relative point I'm trying to point out is here, that we have the same kind of upward trending, but the upside of the mean, where this liquidity area is drawn. Picture this area with your eyes. I'm going to change to the present. Same thing. And then look where the price went. Violent trending move up into the liquidity area, and then a smackdown. Just the same as the previous cycle. Easy to visualize when you have this reference point that's staying consistent despite the exponential move in price. I feel bad for the people kind of looking at price like this, because you're just never going to get ahead. You're always going to be behind the 8 ball, because you can never, you're depriving yourself of the opportunity to see the repeating patterns. Next time in the cycle that it happened was to the downside, actually, which is an interesting illustration of my point that expansion and compression doesn't really care about direction. We have this compression volatility, compression the price ratio, and where does price go if we flip this upside down? It's the same idea. The last liquidity point, this was upside liquidity. If we flip it upside down, you must be seeing that it's the same thing. The last point they were able to commit retail, albeit this was to the downside. They forced retail to sell to them there on this price action and here. And then that was where liquidity went after this compression above the mean and trend beginning. Final example of this with all the signals in alignment is this one, and we had this kind of clustering at the mean, a breakout, and where did we go? Back to the liquidity generation point before the markdown. So that is to say, I think that is where we are. And I think we're just going to get 1 or 2 or 3 candles into the area and begin a distribution. That's what I've been consistently saying for months now, and I have had no falsifying evidence. What would falsify it? If the volatility expansion is in this direction and stays in this direction, then you'd be closing your positions at that point because you're not right. A stop hunt below quickly and then up, possibly, but I don't see the point. They've got the volatility nice and tight. It's probably just going to be maybe a wick through this level and then up. What did not, because it came later in the cycle, have as much of a volatility compression, although we did have the price ratio compression, was the start of the bull run, or start of the markup, should I say, in 2020. So that is why it is important to have a consistent reference point that you can look at and a logical story that you can tell yourself based on that. This is Umbrin Capital. Hope this video is helpful. I'll post an update on this idea when the price plays out.